G'day there. Welcome to the Alpha Wave Trader week ahead. I thought it would be a good idea today to have a quick look at VIX, which is the volatility index on the S&P 500. Pretty useful tool to hedge portfolios or to make a bet on coming volatility. And there's a couple of ways you can play it, by actually trading the VIX itself. But if you don't have access to that, there is a few other products. The VXXB, I believe you can buy as well, which is like an ETF, I guess, on the VIX. But I just wanted to have a look at the sort of long-term situation for the VIX and give you a sense of, why it's possibly not a bad idea to start looking at it as a potential buy. As volatility continues to contract. Now, looking back at the VIX, this is going back to 1991, and you can see I've got a 10-month moving average of the VIX there, which is that black line. It's just interesting to note, over this period since 1990, I've got a horizontal line there at 16. So a level of 16 for the VIX, and you can see when that 10-month moving average breaks below that level, we've had quite a long extended period of low volatility, and when that 10-month moving average heads above 16, we've then had a very long period there from 1997 to 2005 with quite high volatility. And again, just using that line in the sand, as I call it, above and below 16, of when we are in periods of very high volatility to periods of very low volatility. So you can see from 2007 to 2013, 6 years of quite high volatility, where the VIX never really got below 12 during this whole period. And then we have, since 2013, we really have had an extended period of being below 16 for that 10-month moving average, apart from that little period in 2015-16 where we had the taper tantrum, etc. And the volatility did pick up for a while. So where we are right now, we have actually had an increase in volatility with the moving average heading above 16. So it's a possible indicator that we're heading for a bit of an extended period of high volatility. But after the Fed came out at the start of the year and changed their tune, they've sort of really shifted things to more of a low volatility environment. And I guess that is the big question of where we are right now, is whether this 10-month moving average is going to head back below 16, and we're going to see, a period similar to the ones that we've seen in the past, where it is multiple years where there's not that much volatility, or whether, this is just the softening of volatility before we see another high volatility period. And if you do think that growth is softening, and the market has been rallying so strongly for so many years on the back of the accommodation by the Fed, etc., that perhaps we are going to go into a bit of a higher volatility period. This is an opportunity as this volatility heads down towards 12, because if you look back, when has it really gotten below 9? Very rarely. And if you were to buy VIX, if it was to head down below, let's say 12, 11, and you could have a stop loss below that level of 9, you're only risking, because it is about $1,000 per point, US dollars, as a method for either hedging the potential that things could pick up in volatility this year, or just to make an outright bet that you do think the big sell-off that we had in the December quarter last year could actually continue, then there is a case to be made that as this volatility sells off, it's creating a great little opportunity to get long the VIX in this area. And with the March quad witching out of the way, which was last week, this is a period just after all of the options and futures have expired where volatility can pick up again, because often you will see a big rally in the market as you head towards expiry, and a lot of those put options, etc., expire worthless, and the big banks are laughing. And if you look at last year, we had a 6.5% fall in the E-mini in the week after the March quad witching, and on average over the last 30 years, the period after that March quad witching has a negative return average. So this is the period right now after the expiry of options, etc., where there is a higher risk that volatility can actually start to pick up again a little. So as we see VIX heading down towards this 12 level, it's not a bad idea to consider preparing yourself for what could be a return to even just a bit of a higher volatility period. Maybe not heading up to 50, but even just heading back to the mid-20s would see a great return on being long the VIX. And really you only need to place a stoppie around that 9 level, and you should really survive. So that's the idea for today, and we'll see how this week pans out after quad witching. Cheers.